Yes, welcome to Veranda CA. Today, as part of Chapter 9 Audit of Banks, we are discussing the amendments in Chapter 9 Audit of Banks. This is the part 2 of that, of this chapter, because of the amendments in this chapter, because there are multiple amendments. So, first part we discussed certain amendments right from the IT environment to the important amendments which are made in terms of audit procedures in advances, right? So, today we will continue in this session. We will continue these, the other amendments. With that, we will complete all the amendments that are part of this particular chapter. As I said, this is an important chapter. At least 4 to 6 marks will come from this chapter, and considering the amendments that you have, definitely you can expect at least one question from this particular area, right? So, without much ado, let's continue with the amendments that we were discussing. Right now, the first one is on the other assets. So, we already discussed up until advances, the amendments that were made. All this context, all this text is directly from the study material which is published by ICAI, right? So, from a text perspective, everything is from ICAI. So, do not worry on that. Okay, up until advances, we have covered all the amendments which are like the most important part of the amendments in session 1 of this area. In this session 2, we'll see the amendments that are there in other parts of this particular chapter. So, let's continue. There are some audit procedures which are prescribed for deposits, for liabilities, for fixed assets, etc. So, what are the amendments in that area? So, one is stationery and stamps. Now, ensure that the item stationery and stamps includes only exceptional items of expenditure on stationery like bulk purchase of security paper, which is to be written off over a period of time. Now, generally in normal this thing, we kind of don't we write off the entire, any paper purchase, pen, all that we do, that's all stationery, right? So, all that we kind of write it off. We don't though we use it over a period of time, we don't we don't take it to FA and then we don't write it off from there. However, in a banking scenario, in a bulk purchase of security paper, which is a little costlier in nature as well, okay, if that is taken, then we kind of put it in the FA and then we write it off over a period of time. Such items should be valued at cost. Normal expenditure on stationery is to be charged to profit and loss account. So, with the security paper, then it has to be capitalized, otherwise other printing and stationery has to be charged to P&L. Therefore, this item may not appear at a branch level, as considerable part of stationery is supplied to branches by head office, and branch level also it will not be there, because head office generally buys the paper and then they supply to the branch. So, branch will not make purchases. Again, every bank will have their own autonomy, etc. So, that will have to be changed from a case to case basis. Evaluate the existence. Now, this was the change here, right? Evaluate the existence, effectiveness and continuity of internal controls over these items in the normal course of audit. It may be noted that the branch auditor is required to specifically comment on the adequacy of relevant internal controls in the LFAR, long form audit reports. There are certain amendments in LFAR also on the types of audit report as well. We will discuss that as well. Now, non-banking assets acquired in satisfaction of claims. Ensure that heading includes those immovable properties. A company, a borrower is not able to pay, then what the company does, instead of, the company will take a charge on the asset, will take over the asset. So, non-banking assets acquired in satisfaction of the claims. Ensure that the heading includes those immovable properties or tangible assets which the bank has acquired in satisfaction of debts due or its other claims, and these are being held with the intention of being disposed of. You have to sell it and realize it, right? Verify such assets with reference to the relevant documentary evidence, example, terms of settlement with the party, order of the court, or the award of arbitration, etc. Check that the ownership of the property is legally vested with the bank. Bank is the actual owner. If there is any dispute or other claim over the property, the auditor should examine whether the recording of asset is appropriate or not. So, from a rights and obligations perspective, rights and obligations, we have an assertion, right? So, from that perspective, we will have to look at this. In case the dispute arises subsequently, the auditor should examine whether a provision for liability or disclosure of a contingent liability is appropriate, keeping in view the requirements of AS 29. We don't follow Ind AS here in banking companies because it has been deferred by the Reserve Bank of India. If you start following Ind AS, then most of the banks will have to recognize all the provisions, right? Because if Ind AS is being brought into consideration, therefore it's still deferred. till the banks are strengthened. Ensure compliance with Section 9 of Banking Regulation Act and holding period of such assets. Now, ensure that at the date of acquisition, the assets should be recorded at lower of net book value or the net realizable value of asset are required. So, like inventory, right? So, net book value or net asset realizable value as required. I mean, this is special provision for a bank. Now deposits. Deposit is generally liability to the bank. So for us it's an asset, right? If I place an FD, FD is an asset for me, but for the bank it is a liability because banker has to pay after a period of time, right? The interest that is being done, that is an interest that is being given in FD, that's an expense for the bank, right? So current and savings accounts. Verify on sample basis current account and saving account opened during the year for adherence to KYC norms, right? Verify that saving accounts are opened in the name of individuals, HUF, some approved institutions like trust, educational accounts, etc. Remember that saving accounts are not opened for business or professional concerns. Yes or no, we only open current account for them, right? The business transactions are carried in the current account, which can be opened for all kinds of customers like companies, individual accounts, partnership account, etc. So a company cannot have a saving account. I and you can have an individual, we can have a current account, but we cannot have a you as an individual can have a saving account, you as an individual can have a current account as well. If you are a business concern, then you can have a current account. So as a business concern, can you have a savings account? Answer is no, you cannot have a savings account. Like a company, a partnership firm, they cannot have a savings account, they can only have a current account. Why, sir? Savings account, the interest rate is high, current account there is no interest because it is used generally for business. The drawing power, etc. is generally higher for a current account, right? So verify the balances in individual account on a sample basis. Check the calculation of interest. Check the calculation of interest on a test check basis. Remember that no interest is generally paid on current account by bank. Some banks have some 1 or 2% here and there, some interest is there. Examine whether procedure for obtaining balance confirmation periodically has been followed consistently. Examine on sampling basis the confirmation received. So the one which was highlighted in the bold, that is the amended area. The rest is all there. Ensure that debit balances in current accounts are not netted out on the liability side but are appropriately included under the head advances. So if there is a debit balance, that I have paid more, or the bank has paid more, in that case that should not be netted out against the liabilities, but it has to be shown as an asset. It has to be shown as a current account generally will be under the liability of the bank and will be in the asset of the borrower's books, correct? But if there is a debit balance, so it will be a credit balance in the bank's book. But if at all there is a debit balance, then it should not be netted off with other liabilities, but it should be shown under the head advances. So proper classification has to be there. In operating accounts, both current and savings are a high risk area of frauds in banks. Very, very important. Please put an into mark on this. This is a new area, a bold area. This could be a case study. As per RBI guidelines, a savings or a current account should be treated as an inoperative or dormant if there are no transactions in the account over a period of 2 years. So, I mean, I am not sure, but sometimes what happens during the year end, you will get call from all the bankers. Okay, if you have an individual account or if you have a saving account or a current account, if there are no transactions, say you are not using it at all, you'll get a call from the banker saying that, boss, please do some transaction at least. That is just to regularize it, right? If there are no transactions account for a period of 2 years, verify on a sample basis some of the inoperative accounts revived or closed during the year. Ensure that the inoperative accounts are revived only with proper authority. In this regard, cases where there is a significant reduction in balances of such account as compared to the previous year, examine authorization for withdrawal. So this is very, very important, sir. If there are some savings account or current account which are inoperative in nature, what is inoperative? More than 2 years. Then they are inoperative in nature. So what you need to do for them? Verify on a sample basis these inoperative accounts that have been revived or closed. Maybe you need to understand why they have been revived or closed is okay. Why they have been revived, you need to check. Ensure that inoperative accounts are revived only with proper documentation or proper authority. In this regard, cases where there is a significant reduction in balances of such account as compared to the previous year, examine authorization for withdrawal. So if the money has been taken away, why it has been taken away, that needs to be checked, because most of the time what happens, the account is created, if it's a high risk fraud account, it will be there dormant lying there with some balance, and then after one point time there will be a withdrawal. So we need to check that with a keen eye. term deposits. Examine whether deposit receipts and cash receipts are issued serially and all of them are accounted in the registers. Verify in case of bulk deposit, that is 2 crores and above, for scheduled commercial banks presently, correct rate of interest has been offered. In case of closure of term deposit, test check whether required foreclosure penalty has been deducted from applicable rate of interest payable. If you are foreclosing a deposit, breaking your FDs, you will have to pay penalty or foreclosing charges. Verify on a sample basis some of the recurring deposit accounts opened during the year. Verify correctness of the rate of interest on term deposit on sample basis. I think this is very self-explanatory. However, if anything has been asked, you should take it out from these points. Okay, deposits designated in foreign currency. This is important, this is important, this is important. Could be asked as an examination. Verify some FCNR account, foreign currency accounts, right, opened during the year on sample basis and ensure these conform to RBI direction. So what happens in India, you can only have Indian denominated accounts, right? Now, banks also provide certain facilities where you have accounts in which you can keep foreign currency, say USD or euros or pounds or whatever it is, you can keep in foreign currency itself. So that will help you to, suppose you have your majority of your business is exports. So the money that you will get is in USD. Now when it get converted into INR, it may, you don't want to keep in INR because your payments also you have to make in USD. So in order to safeguard, what you do, you keep an account where the balance is maintained in USD only. So that tomorrow when you want to make the payment, you make it in USD and there is no problem in terms of foreign exchange loss or gain. So that is why you have this this is one of the reasons, multiple reasons why you need to have an FCNR account, right? So verify on sample basis permissible credits and debits in FCNR account as per the RBI directions. In case of FCNR accounts, examine whether these have been converted into Indian rupees at rate notified in this behalf by the head office. This is very important. At what rate it has been converted, because when you publish your financials, you cannot put it in USD, you have to convert it. So at what rate it has been converted into Indian rupees, that is very, very important. Not only that, even when it is transferred from a USD account to an INR account, what is the rate which is being used? That's what we need to check. Examine whether any resultant increase or decrease has been taken to the profit or loss account. Verify that interest on deposit has been paid on the basis of 360 days in a year, not 365, 360 days in a year. In case of an NRE and NRO accounts, verify on a sample basis credits and debits as per the RBI guidelines. Also check repatriability. Sir, what is repatriability? NRE, NRO account is for NRIs. So NRE, I'm sure you will know this more in detail. Not so important from an examination perspective. What is more important is this foreign currency. This could be asked in the examination. Okay, repatriability means in the sense there is some money in India parked as an NRE, in the NRE, NRO account. It is being sent back to the money has been repatriated. That is sent back to the say I am staying in the UK and I have some NRE account in India. So now I need money from there. So I take it out. That is repatriability. So NRE accounts are repatriable, whereas NRO accounts are not repatriable except for all current income subject to certain conditions, right? So NRE accounts you can repatriate the money. NRO there are some restrictions. So you need to check whether those conditions have been complied with. Okay, not much, but still it's there as amendment. I have taken it. Now, these are the general procedures that have to be performed. Verify that deposits of a bank are not inflated for the purpose of balance sheet presentation. For example, some customers might be given overdrafts near the date of the balance sheet date and the resultant overdraft amount may be placed as deposit with the banks and further advances may be given on strength and security of these deposits. Year-end irregularities. I am just giving it, at the year end. It should be genuine. It cannot be just for the sake of giving it, I am giving it. Okay, overdrafts are given and then corresponding there are some advances. So advances also increase, your deposit also increase. So therefore, it should not be given just for the sake of showing a rosy picture. This is very practical, it is very difficult to identify, but at least we should take all the overdrafts which are given in the last year and see in the last few days or last 10-15 days and see how, what are the proper documentation is there and what are the documentation that is there for opening these OD accounts, and then we should make a judgment. Okay. The transaction may be reversed after close. So then you should see subsequent this thing also, whether it has been taken away, that also can be checked, right? So, deposit with the bank and further advances may be given on strength and security of these deposits. It would lead to inflated deposits as well as advances. These transactions may be reversed after the close of the year. So, such cases have to be avoided and we need to immediately reverse it. In such cases which indicate the possibility of window dressing, the auditor should consider making a suitable qualification in the main audit report beside other applicable reporting. See, this is very important. Examine that interest accrued but not due on deposit is not included under the relevant deposit but is shown under the head other liabilities and provision. This could be a question in the examination. Interest accrued but is not due. I don't have to make the payment because deposit is maturing after 5 years. Okay, I have to accrue the interest because of matching concept, but I don't have to include it as part of deposit. I have to include it separately under the head other liabilities and provisions. Now, contingent liabilities. This is on the general thing. Now, contingent liability, very important. Liabilities on account of outstanding forward exchange contracts and derivative contracts. There are multiple things here, but only the amended area is what I have taken here. Verify the outstanding forward exchange contracts with the statement of outstanding forward exchange contracts generated from the bank's computerized accounting system or manual register maintained by the branch. So, outstanding FE contract with the statement about with the IT report with the ERP. First, you have to check that the auditor may physically verify the underlying documents, including confirmation from merchants, to test the existence of such outstanding contracts. So, send confirmation to the customers on a sample basis, to see whether the outstanding numbers are matching. The auditor may verify the outstanding derivative contracts like options, interest rate swaps, etc., with reports generated in this regard. Right, as per the reporting requirement. Now, this is on the contingent liability, the amended portion. Now, we come on to the audit report. There are some amendments here which we've already discussed as part of chapter number 5. Okay, again this has been repeated here. So, now what is the format of the audit report that the auditor gives? A central statutory auditor. So, there are multiple audit reports that need to be given. One is your SA 700 report, which we generally give, right, which is prescribed by the standards on auditing. Then you have this LFAR, long form audit report, which you need to give as per the RBI. Then you have this form 3CD as per the tax audit. 3CA, 3CA generally, yes, it is 3CA and 3CD which you need to give. Yes or no? So, these are the different audit reports that need to be given. Okay. So, a general statutory audit under the not only Companies Act, even the Banking Regulation Act, you have to give this SA 700 report. Okay. RBI requires you to give a LFAR, long form audit report. Right. Now, SA 700, so there you have a format. Then as per the Companies Act, there are certain requirements. Okay. CARO 2020 is not applicable to a banking company. We already discussed in CARO 2020 applicability is not applicable to a bank, insurance, electricity, etc. It is not applicable. However, section 143 subsection 3 of the Companies Act, if it is a banking company, Axis Bank, ICICI Bank, all these are bank, HDFC, all these are banking companies, right? If it's a banking company, you will have to follow the reporting requirements. As of course, you have to give a SA 700 report, format should be the same, but under that other reporting requirements, right, you have to give the reporting requirement which are prescribed under the Banking Regulation Act and also the requirements as prescribed under section 143 subsection 3. Now, in 143 subsection 3, which we have already discussed, there have been certain amendments, right? There are three amendments that are there, which we already discussed in the earlier session that we discussed on chapter 5. Whether the company has disclosed the impact, this is already there, sir. This is already there. Now it has been brought, okay. Section 143 subsection 3, whether the company has disclosed the impact of any pending litigations. PMI. M stands for material unforeseeable losses, okay. If any on long-term contracts, including derivative contracts. Then investors protection fund, whether there has been any delay in transferring the amounts required to be transferred to the investors education and protection fund by the company. This has already been there, always existing, right. Now, this is the new area which we have already covered, majorly in my amendments to Schedule 3 class, and also I have covered this in chapter 5 which we discussed yesterday, in my YouTube live. I have discussed this at that point in time also. Again, I am explaining this. Okay, funding party, ultimate intermediary and ultimate beneficiary, right. So, if the funding party is giving money to ultimate intermediary and with the intention, with the understanding that it will be investing it on behalf, it will be giving it to another ultimate beneficiary, or it will be investing to giving it to someone else on behalf of the ultimate beneficiary, such transactions have to be disclosed by the auditor. So have to be disclosed as per Schedule 3 to the Companies Act. It has to be disclosed as per Schedule 3 to the Companies Act. Now there will be a corresponding amendment in Banking Regulation Act also. Okay, it has to be disclosed. Where it is not disclosed, then it has to be reported under section 143 subsection 3. That is the reporting requirement. So let me read it out for you. Where the management has represented to the best of its knowledge and belief, other than as disclosed in the notes to accounts, no funds have been advanced or loaned or invested by the company to or in any other persons, including foreign entities, with the understanding, whether recorded in writing or otherwise, that the intermediary shall whether directly or indirectly lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company, or provide any guarantee or security or the like on behalf of the ultimate beneficiary. This is the first point. So where this is from a funding party's requirement. This I have taken this multiple times. I would if you've not understood this, I would request you to go through my earlier videos, in which I have taken this in detail. That's why I'm skimming this part quickly. Where the management has represented to the best of its knowledge and belief, other than as disclosed in the notes to accounts, no funds have been received. This is from an intermediary perspective. No funds have been received from the company from any persons, including funding parties, including foreign entities, which are the funding parties, with the understanding, whether recorded in writing or otherwise, that the company shall whether directly or indirectly lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the funding party, or provide any guarantee, security or the like on behalf of the ultimate beneficiary. This is a statement where intermediaries, where they receive money from a funding party with the understanding to put it in some other company, that is the ultimate on behalf of some other company, that those transactions have to be put forth in the Banking Regulation Act. In the financial statement, in the financial statement, if they are not disclosed, then we have to report it here. Based on such audit procedure, the auditor has considered reasonable. So, because the first two clauses are representation by the management. If you look at this, also is representation by the management. Management is not representing anything to me. That's why I am using this. However, the third clause is your judgment. Based on the audit procedures that you have performed, you think that these representations are appropriate and they are reasonable, and nothing has come to your notice that has caused you to believe that the representation that subclause 1 and subclause 2 contain any material misstatement. So you have to put forward your thoughts. Now, the next one is whether dividend declared or paid during the year by the company is in compliance section 123 of the Companies Act. Okay, so this is also another reporting requirement. This is something which we discussed earlier. This is on the ERP, Audit Trail. From a banking perspective also, it's very important. So all the more this highlights the IT environment here, right? So this is applicable from what we discussed earlier. The 4th and the 5th clause is applicable from 1st April 21, but this clause is applicable from 1st April 22. Okay, so where the company in respect of financial years commencing on or after 1st April 22 has used accounting software for maintaining its books of account, which has a feature of recording audit trails, and the same has been operated throughout the year of all transactions recorded in the software, and the audit trail feature has not been tampered with, and the audit trail has been preserved by the company as per the statutory requirements for record retention. So every ERP, every accounting software need to have an audit trail, with an edit log facility. Okay, what is an audit trail? It is generally a step-by-step procedure where any entry that is passed should be able to trace to the source. You should be able to trace it to the document. Okay, so your ERP should have the facility. I have a feature of recording the audit trail right from the source document till the passing of entry. Such kind of an audit trail has to be recorded with an edit log facility. Edit log facility in the sense, if someone has edited any trail, okay, that has to be popped. Okay, this was edited at this point in time. So that is what is important over here. Now, the next one is a long form audit report. Now, this is given by the Reserve Bank of India, and this has to be done by all the banks. Okay, if the banks and the branches of the bank. So the branch auditor will do branch LFAR, which will be consolidated by the central statutory auditor. He will do the main LFAR, which will be submitted to the Reserve Bank of India. Besides the audit report, as per the statutory requirements discussed above, the terms of appointment of auditors of public sector banks, private sector banks and foreign banks as well as their branches require the auditors to also furnish a long form audit report. The long form is basically a questionnaire. A long questionnaire is there which you need to answer, right? It's like a 3CD. The long form audit report is to be given by the statutory branch auditors as well as statutory central auditors. The LFR for branch auditors is in the form of a questionnaire where observations or comments have to be provided in range of matters including cash, bank balances, bank investment, advances, deposits, etc. These are submitted by the statutory branch auditor to the statutory central auditors, and from there it is going to the Reserve Bank of India. The consolidation is done at the head office level, and the LFAR for the bank is submitted by the central statutory auditors to the management. The LFAR on the bank after due examination should be placed before the ACB of the bank, the committee, indicating the action taken or proposed to be bank for rectification of the irregularities, if any, mentioned therein, and the copy of the LFAR and the relevant agenda note together with the board's view or direction is submitted to the RBI within 60 days of submission of LFAR by the statutory auditor. Sir, this is very, very important. Could be a potential examination MCQ. Okay, 60 days we will all know, but from which date? From which date does the RBI has to submit the LFAR to, the bank has to submit the LFAR? 60 days from the date of submission of LFAR by the statutory auditors. So branch auditors will give it to the statutory auditors, statutory auditors will consolidate or the head office will consolidate, statutory auditors will give the central LFAR to the management of the bank. It will be placed before the ACB. Okay, once it is placed before the ACB and all the steps have been taken, then it has to be given to the RBI. Okay, now this is how many times, how many days? 60 days from date of submission from here. From here it should take 60 days. So that's important. From which date? From date of submission by the statutory auditor to the management. Right? So yes, with this we complete the discussion on the amendments. I mean, this session was very short because most of the amendments have been covered in part 1 of the schedule. So with that, all the amendments, most of the amendments, then there are some amendments in concurrent audit which are not very important from an examination perspective. It's just few paragraphs which are added here and there. But most of the areas are covered. Sir, what is very important is your advances. Okay, advances, what we discussed in session 1. Those are areas where a lot of questions can be asked. Some suggested audit procedures also they have included. Some case studies based out of those suggested audit procedures can be asked from this perspective. Okay. Most likely for this attempt that you may get questions mostly on the amendment because it's a sunrise this thing. So I really want you to kind of go, it's a very big chapter I understand, but I really want you to go through these amendments and go through this chapter so that you can score well in the examination. Please consolidate your these amendments by reading once from the study material. Till then, take care and thank you.